In the world of trading, there are two main approaches traders often rely on: prediction and reaction. These are just two different ways of looking at the market. And while they both aim for the same thing, making money, they do so in very different ways. Imagine you're trying to figure out whether it's going to rain tomorrow. One option is to study the weather forecast, track cloud patterns, and analyze atmospheric data, trying to predict the weather in advance. That's what prediction in trading is like. The other option is to simply step outside, feel a few drops on your head, and grab an umbrella. That's closer to reaction-based trading. Let me break this down further for you. Prediction can be powerful if you're right. Imagine correctly predicting that a certain company's stock is going to skyrocket after they release their quarterly earnings report. You could make a significant profit by getting in early ahead of everyone else. However, the big downside to prediction is that the market can be unpredictable. Even if you've done all the analysis in the world, there's always the risk that something unexpected will happen: a CEO scandal, sudden government regulations, or global events like a pandemic that can throw your prediction off. This makes prediction-based trading a bit risky, as you're essentially betting on the future. On the other hand, reaction-based trading is all about waiting to see what the market does and then responding. It's like standing back and saying, "I'll only make a move when I see something concrete happen." These traders don't try to outguess the market. Instead, they wait for a clear sign, a price break above a certain level, for instance, and then jump in. Imagine the price of gold starts rising quickly because of some geopolitical tension. A reactionary trader wouldn't predict the rise ahead of time, but would see the price moving, react to it, and hop on the trend to ride the wave. The beauty of this approach is that it takes away some of the uncertainty. You're no longer guessing what might happen, you're acting on what is happening. This can make reaction-based trading a bit safer in the sense that you have more confirmation before making a move. But here's the catch. Since you're waiting for confirmation, you're often getting into the trade a bit late. That means you might miss out on some of the profit you could have made if you had predicted the move earlier. You're jumping in after the trend has already started, so the price might not be as favorable as it was when the move first began. Let me give you a practical example of how this plays out. Let's say there's a stock that you think is going to drop after its earnings report. A prediction-based trader would do some research, analyze the company's financials, and perhaps take a short position, betting the stock will go down before the earnings report comes out. If the stock does drop after the report, the trader profits. However, if the earnings are better than expected, the trader might lose money because their prediction was wrong. Now, a reactionary trader would do the opposite. They wouldn't make a move before the earnings report. Instead, they'd wait for the report to come out. If the stock starts dropping after the bad earnings report, only then would they jump in, short the stock, and try to ride the wave down. Sure, they might make less than the person who predicted the drop earlier, but they'd also avoid the risk of being wrong about the report in the first place. Ultimately, the key difference between prediction and reaction is about timing and risk tolerance. People who prefer predicting are usually more willing to take risks because they believe they can anticipate market moves before they happen. They're trying to get ahead of the curve, which can pay off big if they're right, but can also backfire if they're wrong. Reactionary traders are a bit more cautious. They'd rather wait for the market to show its hand, even if it means missing out on the earliest profits, because they want that confirmation before they act. Neither approach is necessarily better than the other. It all depends on your style as a trader. In fact, many experienced traders blend the two approaches. They might predict long-term trends in the market, but react to short-term changes as they happen, creating a more balanced strategy. So, whether you find yourself drawn more to prediction or reaction, Both approaches have their strengths and weaknesses. It all boils down to how much risk you're comfortable with and how well you know the market. Either way, the goal is the same: to make the best decisions you can with the information you have and hopefully come out on top.